Welcome back to the Global Ledger. I'm Justin. When most people hear the word arbitrage, they think free money. Buy something cheap, sell something expensive, lock in the difference, no risk. But in modern markets, arbitrage isn't free. It's funded. And when arbitrage is funded at scale, especially through short-term borrowing, it can become one of the largest sources of systemic risk in the entire financial system. Today, we're going to talk about basis trades, what they are, why they exist, why they look safe, and why under stress they can threaten market stability itself. This episode sits at the intersection of microstructure, leverage, and liquidity. Let's get into it. So this episode should hopefully explain events like treasury market dislocations, repo stress, sudden spikes in volatility, and why risk-free trades sometimes blow up first. But before we talk about that, we need to talk about what a basis trade is. Okay, a basis trade exists whenever two instruments that should trade at the same price do not. The basis is simply the price difference between them. Okay, so here's some common examples. Cash treasury bonds versus treasury futures. Okay, that's one. ETFs versus their underlying baskets. Another one would be interest rate swaps versus government bonds. And another one would be on the run versus off the run treasuries. Okay, in theory, these prices should converge. So traders step in, buy the cheap leg, sell the expensive one, and wait for convergence. That sounds harmless, and it kind of sounds stabilizing. But here's the key point: basis trades are not about valuation; they're about balance sheets, and the price differences in basis trades are tiny. That means to make meaningful returns, you need enormous scale. To get that scale, you need leverage. And most basis trades are funded using repo markets, margin financing, and short-term secured borrowing. Okay, a hedge fund doesn't own the treasury bond outright. It borrows against it. Okay, this creates a structure that looks like something like this. Okay, long asset, cash bond, okay? Short hedge, futures or swaps, funded with rolling short-term debt. That's kind of a classic, structure, okay? As long as funding is cheap and available, everything works. But the risk is not price risk, okay? The risk is funding risk. Under normal conditions, basis trades do compress spreads, but under stress, the mechanics flip. Here's kind of what happens. Okay, number one, volatility rises. Number two, margin requirements increase. Number three, repo haircuts widen. Number four, funding becomes scarce. Okay, now the arbitrager faces a problem. Okay, so the trade hasn't failed economically, but the balance sheet can't carry it. So positions are unwound. And when many funds unwind the same trades at the same time, prices diverge further, liquidity evaporates, and volatility accelerates. Okay, this is why arbitrage can amplify stress instead of dampening it. Okay, so the most important example in the world today is the treasury basis trade. Okay, what this involves is long cash treasuries, short treasury futures, funded through repo. Okay, it exists because futures embed funding assumptions, and exists because cash bonds reflect the real balance sheet constraints. So when funding markets are calm, this trade hums quietly in the background. But when funding tightens, this is where you'll see a spike in repo rates, and futures starts to dislocate. And cash bond liquidity starts to collapse. This is exactly what we saw in September of 2019, March 2020, and kind of episodically since. The danger isn't default risk, okay? It's the danger is forced balance sheet contraction, in the most important market on earth, mind you. Okay, so, but why is this systemic? Basis trades concentrate risk in three places: short-term funding markets, number one; dealer balance sheets, number two; and market liquidity itself, number three. When basis trades unwind, dealers absorb inventory they don't want. Repo markets clog. Bid-ask spreads widen. Okay? Price discovery breaks down. That's how a technical trade becomes a macro problem. This is also why authorities increasingly monitor hedge fund leverage, repo market capacity, clearing and margin dynamics. Okay? Not because arbitrage is bad, but because funded arbitrage links microstructure to systemic stability. Okay, so once you understand basis trades, you understand why ETFs sometimes trade at discounts, or why volatility can spike without, bad news, and why market plumbing matters more so than narratives. Markets don't break because people are wrong; they break because balance sheets hit limits. Before we close, I want to pause and clear something up, okay? Especially for listeners who have been following the myth-busting series, okay? Before I wrote this episode, I figured putting something in here like this would be important. A few episodes ago, we did a myth-busting episode titled "Japan Isn't Breaking the Financial System." That episode focused on the yen carry trade, and the takeaway was clear: Japan's low rates and domestic financial structure are not some ticking global time bomb. Okay, so you might be wondering, wait, aren't basis trades just another carry trade? And didn't you just say carry trades can become systemic in this episode? And this is where the distinction really matters. And I want to make sure that this is clear. Okay, there may be, because if I left this out, there would probably be some questions. So let's talk about this really fast. Okay, so carry trades and basis trades are not the same thing. A carry trade is fundamentally about interest rate differentials. Okay, you borrow in a low rate currency, you invest in a higher yielding asset. Your return comes from the spread, and that's over time. The yen carry trade is typically currency based. It's often unsecured. It's dispersed across many actors. And crucially, it is not anchored to a single market's liquidity. That's why the myth that Japan will blow up the global system doesn't hold. Okay, basis trades are about balance sheets, not rates. Okay, a basis trade is different. It's not about yield. It's about price convergence between two instruments. Okay, and more importantly, it is heavily collateralized, heavily levered, heavily concentrated, and directly embedded in market plumbing. Basis trades sit inside repo markets, dealer balance sheets, clearing systems, margin frameworks. So when a basis trade fails, it doesn't just unwind, it stresses the pipes. Okay, and that's why treasury basis trades matter systemically, while most yen carry positions do not. And this distinction is really the whole point. Okay, so no, what I'm saying here in this episode isn't a contradiction. In fact, it's the same framework applied correctly. The yen carry trade is a macro positioning story. Basis trades are a microstructure and funding story. One can unwind slowly without breaking anything. The other can freeze markets overnight. And confusing the two is exactly, in my opinion, how financial myths can get created. The bigger lesson, the lesson isn't carry trades are dangerous, and it isn't arbitrage is safe. The lesson is this: systemic risk lives where leverage, funding, and market infrastructures intersect. Okay, that's what we're mapping here, or trying to, anyways, episode by episode. Okay, so Now that we've separated carry trades from basis trades, we can take the next step. Okay, so in episode 77, which is the next episode, we're going to look at ETF liquidity, okay, and how creation and redemption mechanics rely on the same arbitrage and funding channels we discussed today. Okay, so if basis trades show how arbitrage can become systemic risk, ETFs, I think, show how that risk can surface directly in portfolios people think are passive. Thank you for listening to episode 67, or excuse me, not 67, 76 of the Global Ledger. And I'm Justin, and again, thank you for being here.